In today's video, I'll be sharing the story of a retiree who thought that $2 million would deliver financial security, and how a single overnight event shattered decades of retirement planning in ways that proper preparation could have prevented. If you're new to the channel, hi, I'm Julia Lemke, certified financial planner and managing director of URS Advisory. And through working with clients who've experienced retirement plan failures, I discovered that the difference between retirement success and disaster often comes down to factors most people never consider when they're focused solely on accumulating a target number. And that's exactly why I'm making this video today, to walk you through what happened to this retiree's $2 million plan and show you the critical mistakes that turned what should have been a comfortable retirement into financial crisis. So let's get into it. Meet Robert, age 60, with $2 million saved across his 401k, IRA, and savings account. He has one daughter, Victoria, and a grandson, Graham. Broken out, he had $50,000 in his savings account and the other $1.95 million between a traditional 401k and IRA. He didn't have access to a pension, so his guaranteed income stream is Social Security, which he'll take at full retirement age for $44,500. His advisor confirmed that $2 million should safely give him about $100,000 per year using a 5% withdrawal rate, 30 years of income with average growth, a portfolio that should last until 90. Of course, we're accounting for a slow-go and no-go spend of 20% less starting at his age 80, all indexed at 3% inflation. So on paper, he did everything right. He saved 15% of his income every year. He kept a healthy mix of stocks and bonds. He stayed disciplined through market ups and downs. By every traditional metric, Robert checked all the boxes. According to the numbers, Robert had hit the target most only dream about. His plan looked secure, looked predictable. It looked like the exact blueprint every financial article tells you to follow. Knowing this, Robert felt completely ready to retire in January of 2022. He had also lived through decades of strong market returns for most of his working life. Seeing 7 to 8% growth felt normal. That long run of positive years made those return assumptions feel safe and reasonable. It was easy to believe that the future would look like the past. He also believed his investment plan was conservative. He was not chasing high-risk ideas. He held a balanced mix of stocks and bonds, he stayed diversified, and he kept costs low. It all felt very responsible, and most of all, again, Robert had hit that number that he had aimed for since his mid-40s. Reaching it gave him a sense of completion and certainty. It felt like proof that he had done everything he was supposed to do. From his perspective, the timing felt right and the numbers looked solid. And that's exactly why what happened next caught him off guard. The turning point came almost overnight. 2022 was the year almost everything fell at the same time. It was not a normal correction. It was a rare environment where stocks went down sharply and bonds also dropped at the same time. Back in the 90s and early 2000s, when stocks would struggle, high-quality bonds would help soften the blow. But in financial crisis, and especially in 2022, they did not. The year started with the Federal Reserve raising interest rates at one of the fastest paces in modern history. Inflation was running at levels we had not seen in 4 decades, and as rates went up, the value of existing bonds went down. At the same time, higher borrowing costs and slowing growth pulled stocks lower. The result was a double hit. The S&P finished the year down about 18%, core bonds fell roughly 13%. There was no safe corner of a traditional portfolio. A standard 60-40 portfolio experienced losses on both sides, and this made 2022 one of the worst years ever for retirees who relied on a balanced portfolio. It created the perfect setup for sequence of returns risk. Anyone who had just started withdrawing income felt the damage immediately because losses and withdrawals were happening together. Looking at Riskalyze, we can see that using his exact holdings, he lost 15% his first year of retirement. Again, Robert entered retirement with $2 million. By the end of that first year, the market decline plus the $100,000 living expenses pulled his balance down to about $1.6 million. The single year changed everything. Robert's entire 30-year plan relied on steady, long-term returns and smooth withdrawals. The math collapses when large losses hit at the exact moment you begin pulling money out. So his plan looked perfect on paper, but that first year created stresses in a plan that were not part of the original projections. We can see here on his cash flow report what this looks like with above-average returns. And we can see that it's not an issue, right? But we already knew that. We're not going to build a plan based on above-average market assumptions. In average returns, right? Still no issue with his current assumptions. And then below average returns, where we see that he's out of money at age 88 using current assumptions. You might say, hey, big deal. 88 is old. And you're right. But what if he lives to 90? What if he has other expenses pop up that we're not currently accounting for? What if he needs long-term care? This bad year hit Robert much harder than the market swings he had lived through while he was working. Even though losing, 15% is nowhere near what he lost in the 2007 to 2009 Great Recession. Why is that? Well, of course, during these downturns, he was still working, right? He was contributing to his accounts, which meant that he was buying shares at lower prices and giving the portfolio time to recover. So losses were uncomfortable, but they were not damaging. Retirement works differently. This is where, again, the sequence of returns risk comes in. When large losses happen early in retirement, the portfolio suffers permanent damage because withdrawals are happening at the same time. To cover living expenses, Robert had to sell investments when prices were already depressed. Those shares were gone forever. So even if the market recovered later, the portfolio started that recovery with fewer shares, so it could not fully participate. This forced selling is what creates a long-term problem. The market may bounce back, but the portfolio does not return to its original path. The math never realigns. This crash also exposed several other weaknesses in his plan that he had never stress tested. So let's go to the Monte Carlo analysis to show you what I mean. For those unfamiliar with Monte Carlo, it is the best way to test the success of a financial plan. So simply put, a computer takes 1,000 different stock market scenarios between now and Robert's life expectancy. A third of the scenarios use above average stock market performance, a third use average market performance, and the final third use below average market performance. So this is what I showed you earlier. The computer then takes your baseline of information, so Robert's age, life expectancy, goals, investment allocation, income, expenses, etc., and it runs it against all 1,000 of these stock market outcomes, giving us a percentage of likelihood that you will make it to your life expectancy without running out of money. We're looking for a score of 80% or higher. An 80% Monte Carlo score is considered a healthy target because it shows your plan succeeds in the vast majority of market scenarios while still giving you flexibility. It means that in 8 out of 10 possible futures, you can meet your goals without running out of money, and in the remaining cases, only small adjustments like modest spending changes may be needed. Trying to push that success rate to 95 or higher often means sacrificing too much by spending less, delaying retirement, or just taking more risk than necessary. In other words, 80% strikes the right balance between confidence and quality of life, providing a plan that's resilient but not overly conservative. Okay, so here we are in the Monte Carlo, and we can see that when Robert loses 15% his first year of retirement, his chances of success are 68%. The main issue here is that if the market gives us below average returns moving forward, he would run out of money at age 85. We'd much prefer to see this at age 90 or above, as longevity risk is a real concern. Had he retired the year of a bull market, his chances of success increased to 92% with no chance of running out of money. And there was another issue that quickly surfaced. His tax situation made everything worse. You'll recall that over 1.9 of his $2 million sat in traditional retirement accounts, right? 401ks and IRAs. He had no Roth money and only a small amount in after-tax. Therefore, he had zero flexibility. He needed $100,000 per year to live on, but that's a net figure. So he really had to draw close to $120,000, which pushed his withdrawal rate up to 6%, which is very hard to sustain when you retire the year of a bear market. Because he never did Roth contributions or conversions during his working years, or saved outside of his 401k, he had no alternate source of income when the market falls. He could not pull from a Roth to avoid taxes. He could not tap a brokerage account to avoid selling stocks at depressed prices. Every dollar had to come from the same place, which increased stress on the portfolio at the worst possible time. And this lack of tax planning obviously didn't cause the crash, but it limited his options once the crash occurred. That is what made a difficult year turn into a longer-term problem. If any part of Robert's story feels familiar, I put together a free training that walks you through how to strengthen your own retirement plan. You can watch it using the link below. Okay, now let's look at what would happen if Robert had unexpected expenses. Unexpected expenses are just an inevitable part of retirement and just life in general. In our practice, we have each client list out their spending, both base spending and time-bound discretionary spending goals. And 9 times out of 10, these figures are sort of understated, right? And the client runs into unexpected spending, home maintenance costs, gifts, medical events, etc. Well, for Robert, this would be a major issue if his net spending creeps over $100,000 a year. So let's take a look. First, he'd really like to gift $5,000 a year for the next 10 years to his grandson in his 529 education account. That takes his chances of success from 68% to 62%. Next, his condo has a special assessment of $25,000 that he'll need to pay in 2027, further reducing his chances to 58%. Now, this is well below 80%, right? This is how seemingly minor, unexpected expenses can affect the viability of a retirement plan. Now let's see how he'd fare if he needed long-term care between ages 85 and 88. And we can see that without those unexpected expenses, his chances reduced to 52%. But with the gift and assessment, his chances reduced to just 43%. Of course, he'd most likely sell his condo if that happened, so his chances of success increased to 62%. But again, we like to see 80% or close to it to feel good about a client's future for the reasons I explained earlier. So Robert's story shows us what can go wrong, but understanding his critical mistakes can help you prevent this for yourself. Robert's plan fell apart because the structure of his retirement was flawed from the start. His seemingly balanced portfolio exposed him to the full impact of sequence of returns risk his first year of retirement. The moment the market dropped, his portfolio dropped right along with it. He had no time to adjust. He also had no tax diversification. Nearly every dollar he withdrew came from the same taxable bucket, so he had no flexibility to shape withdrawals in a down year. Without much of an emergency reserve, he was forced to sell investments at the worst possible time. These issues created a system where any early market correction would have produced the same crisis. And lastly, his $2 million target number didn't apply to his specific needs. He focused on hitting a balance instead of building a withdrawal strategy, tax plan, and risk management framework. His advisor signed off on the plan because the account balance looked strong, instead of signing off because it met all of Robert's needs. Conventional planning ignored the weaknesses that market timing exposed. With proper planning, he could have avoided this crisis entirely. A diversified allocation, a dedicated reserve, and realistic projections would have given him stability and options during the downturn. Now that you understand what went wrong, let's look at the framework that prevents this catastrophe. The framework starts by setting aside 3 to 5 years of spending in conservative allocations. Unfortunately, bond funds do not count unless they're very, very short-term bond funds, as these lose value with the stock market in times of duress. I'm talking about high-quality individual bonds, very short-term bond funds, money market funds, CDs, fixed annuities, and the like. This single step prevents forced selling during market crashes. When equities fall, the retiree draws from safe assets instead of liquidating stocks at depressed prices. Tax diversification, which you know by now I preach on often, is another core piece. Diversifying your tax landscape during working years builds withdrawal flexibility later. With both after-tax and tax-free buckets, the retiree can choose the most efficient source of income during down markets, which stabilizes the plan. When these layers work together, the cascading failures that destroyed Robert's plan do not occur. The portfolio drawdowns will not affect your lifestyle. A retirement plan survives overnight shocks when it is built on stress testing, so running sequence of return scenarios before retirement reveals these weak points early on. Protection strategies can then be implemented years before the first withdrawal. And this preparation is what prevents crisis when the markets inevitably fall. Lastly, we know now that target numbers alone cannot deliver security. A comprehensive approach is built on diversification, reserves, tax flexibility, and risk-tested planning. This is what allows these retirees' plans to survive the same market events that destroy accumulation only or just, hasty retirement plans. Okay, now that you understand how Robert's $2 million retirement shattered overnight, and how sequence risk, tax concentration, and poor market timing combine to destroy what looked like a secure retirement, you can implement the protection framework that better delivers retirement security. And if you need help building a protected retirement plan for yourself, click the link below to watch my free training video that walks you through our exact process.